Good morning from London. I'm Anna Edwards alongside Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. A big beat for UBS. The Swiss lender smashes expectations with net income almost double estimates. We will bring you our interview with the CEO Sergio Ermotti in just a few moments. A tale of two AI fortunes. Google's bet on the technology sends cloud sales sky high, but chipmaker AMD slumps as its AI revenue estimates underwhelm investors. Plus, Rachel Reeves prepares to unveil the first budget of the UK's new Labour government, with the Chancellor expected to reveal a major package of tax hikes and new debt rules.
And let's check in on these markets then. Yes, the earnings story is certainly part of the mix. The banks coming through again with some really decent beats coming through from Standard Chartered and UBS. On the technology front, it is all about Alphabet as we build up to the details at a Microsoft. And here in the UK, of course, it's all about that budget. European futures, after a little softness yesterday, pointing lower by 0.2%. Here in the UK, the FTSE 100 looking to lose 25 points. We continue to focus on gilt as well around that budget. And US Treasury set for their worst month in about 2 years. Currently, 424 is being yielded on the benchmark 10-year, euro dollar at 108. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is Bloomberg, the opening trade. We are deep into earnings season here in Europe, and that means in just a moment or two, Tom, we have an interview with the CEO of UBS to bring to our audience. But this was an incredibly strong set of numbers, wasn't it, coming through from UBS? Better than estimated in terms of the wealth management unit, the investment banking side of things, confirming their cost savings. A little concern around the macro outlook, but broadly a really strong set of numbers.
Absolutely smashing it in terms of the net income for the third quarter. 1.43 billion US dollars. The estimates have been for 783 million. Our team on the ground in Zurich saying the integration of Credit Suisse is ahead of the timescale, so that's a positive as well. And in terms of cost savings, looking at around 7.5 billion US dollars for the full year of 2024. So that is pretty significant in terms of the cost savings for this business as well.
Yeah, so the cost certainly in focus and what they're able to do there. Really interesting, the speed at which they're able to integrate a business the size and scale of Credit Suisse, because just yesterday, listening to the chairman talking in an event, he was saying that eventually they want to buy a big US or buy a US wealth management company, and that would help them better compete in the United States. And he was saying in the process of that it will take 3 years to digest Credit Suisse, which seems extremely escalated or speedy timescales. So let us focus on the numbers, the beat from UBS, also the broader macro landscape. Here's the CEO, Sergio Ermotti.
And if I look at the macro and geopolitical front, the US election for sure won't be an uneventful topic. So I think that no matter who wins and how they win and how things play out, you're going to see changes and movements in markets. So it will remain to be seen how investors will react to that.
And the US election is exactly 7 days from now. So how do you prepare for that?
Well, we are prepared to basically stay close to clients, advise them, and on how to eventually position themselves and take advantage of any movements. But also, from a bank standpoint of view, of course, we are always prepared for major events.
But so, what do you exactly worry about? Is it market volatility, uncertainty, or is it also the impact, for example, of a Trump presidency on tariffs and on bank regulation?
No, that one is not really the issue. I think that right now the markets are pricing rather a Trump victory, and think that if this is confirmed, it remains to be seen. Is a classical sell on news event, or how he wins will be also determining. Is he in control of the Congress? If Kamala Harris wins, of course, some of the trades that are ongoing for Trump will probably have to be reconsidered, and therefore they're going to create rotations in the market and other movements. So I think, as I mentioned, it's not going to be an uneventful topic.
Does that mean, extra inflation? And how do you think it impacts, is there going to be a standstill of M&A, again, depending on what happens and who wins and how they win?
No, inflation, I don't know. Inflation is probably going to be more, a consequence of the ability of central banks to really do the last touch and really bring in core inflation below their targets. And the risk there is probably more coming from the geopolitical front. Any dislocation in respect of supply chains, energy access, energy prices can bring back inflation to a level that may slow down the pace of rate cuts. But on the rest, I think that we are well prepared for any scenario.
Sergio, on share buybacks, I mean, you have a pretty hefty, number that you want to give back. Is there anything that puts that at risk?
Well, I mean, it's fairly modest compared to what UBS and other banks are doing nowadays. Is somehow reflecting the fact that we are still midway into the integration. We need to still absorb a lot of cost to restructure and Credit Suisse. So I think that despite the fact that we have very strong results, we still are halfway in the journey to restore the profitability levels that are allowing us to have the similar return on capital we had before the acquisition.
But so again, there are many questions about extra capital requirements also by the Swiss authorities. How does that impact actually your thinking on share buybacks and dividends?
It's a consideration so we always have to think about, but in the short term, this is not going to affect our policy. We are executing our 2024 plans, and we believe that also for 2025, this will not be a major issue, and then of course we have to consider all the elements, but our aim is to continue to our aim is to deliver same levels of capital returns UBS had before the acquisition by the end of 2026.
How are your conversations going with Swiss authorities on these capital requirements, and where do you think they'll land? There's a range between 10 billion and 20 billion.
The conversation are still at technical levels, so I think that it's premature to, the rest is going to be, once we finish technical level discussions, there's going to be then a consultation process. We are not in control of timing, so in that sense, it's way too early to speculate or on this matter. We do believe that we have a very strong capital position, and we do hope for a proportionate outcome.
That was the UBS CEO, of course, Sergio Ermotti, speaking to our colleague Francine Lacroix, who is in Zurich. And let's get to Fran now, over in Switzerland. Francine, some of the key challenges, of course, facing the industry outlined there, and the volatility to be expected in the short term. What are the other key challenges facing this business?
Well, and I think if you look at some of the policy on dividends and share buybacks, it's really that regulatory incoming from the Swiss authorities, which he said very clearly there's no timeline and he doesn't really know where it lands, whether it's 10 billion or 20 billion, which is maybe why they're a little bit more cautious on the CET1, or certainly they've readjusted so that if there were to be a windfall, it wouldn't be such a shock to the markets. But overall, look, the trend is fine. They're accelerating. They're doing better than expected and more quickly than expected. A couple of other things we need to watch out for is what we heard from the chairman of UBS yesterday, saying, look, they're also ready in a couple of years to buy wealth management. So I tried to press the chief executive on this morning, and Sergio Ermotti says, look, we're halfway there in terms of the integration. In terms of IT, they're migrating some of the Credit Suisse also clients to the UBS platform, which should be fine, but there's always a risk because of it's hundreds of billions actually of pages that needs to move from one platform to the other. And then the big question is, once this happens, and he says, look, the integration is advancing faster than expected, halfway there, is what do they buy? And again, they have these pillars of Asia's growing okay. We also spoke about possible consolidation in Europe, what happens to the Swiss market, and then the US. It was very clear from the chairman yesterday that they wanted to buy in the US because they saw better returns. But then we also have a lot of question marks, as you heard there from Sergio Ermotti, about the fourth quarter performance because of this volatility, which may not be good for the markets, depending on what happens with the US election. And it's not only the outcome, but actually the uncertainty that the US election could bring. If it takes 30, 40, 45 days to really see who's president, then you're going to see clients probably being a little bit more nervous. And so the pitch from Sergio Ermotti was very clearly, we're going to try and stay as close as possible to the clients to be there in difficult times, which we could see in the fourth quarter.
Francine, thank you. Bloomberg's Francine Lacroix with the latest from her interview with the CEO of UBS. Exchequer Rachel then some of the lines coming through from him around M&A within the banking sector, Chinese stimulus, so a wide-ranging conversation. We'll try to bring you more of that later on in the programme. Tom, let's get back to some of the earnings stories that we've had out this morning. And should we start with VW? Because this one, of course, we were braced for something pretty negative, given the couple of profit warnings we've already seen. Cash flow and operating profit coming in lower than estimates. Does this go a long way to justify the plan that the business has to close at least 3 plants? Labour leaders in the company are due to talk later on today, but there's weakness across the geography here when it comes to VW.
And execs is already pouncing on these numbers, actually, to say, look, this underscores the need for those cost cuts and those reductions in terms of the closures, potential closures of those plants. As you say, the conversations with the unions will continue today. Really consequential time, of course, for this business. On technology, very different story in terms of Alphabet, the parent company of Google. Really solid beat, particularly when it comes to the cloud computing business. They saw revenue increasing 35%. Overall revenue reaching just shy of $75 billion in the quarter for Google, for Alphabet. So some of those bets are paying off. Will that read across to Microsoft later today? They have their own cloud unit, of course, and then Meta. Particularly when it comes to the advertising part of the business and Meta, to what extent are those AI bets paying off for them as well?
Yes, absolutely. So that's a real focus. So the AI boost working at Alphabet, AMD, a more negative story. So the company's revenues there, or the estimate for the revenues they're going to make from the fourth quarter, that seemed to be specifically the area that was under pressure when it comes to the AMD numbers. And they're developing and running, they're trying to provide these chips, the MI300s, you know more about this than I do, Tom, but to provide AI accelerators with the chips that enable them to develop and run the AI data centres. And this is where it's crucial to watch AMD, because they have a chance of competing with NVIDIA in this space, and that's why we watch this closely.
Absolutely. It's a really good indicator of that demand and to what extent they are closing the gap with NVIDIA.
Yeah, so that stock down more than 7% in after-hours trade, so we'll watch how tech performs there. On to the UK today, and we get the budget, of course, taking place. Could we see one of the UK's biggest ever tax increase events taking place today? Although I should say that recently the competition for that accolade has been quite strong. Probably not as much, according to Bloomberg analysis, probably not as big an increase in tax takers' percentage of GDP as we saw under Sunak in 2021 or Lamont in 1993, so worth bearing those in mind. Memories of Truss, of course, Liz Truss and her mini-budget that ended up not being quite so mini for gilt markets, that's certainly in focus. With that in mind, we watch carefully the change in the debt rules. Looks as if we're going to get one that's going to be about day-to-day spending being funded by taxes, and one about fixing the date by which debt has to come down and changing the definition of debt. So a lot to watch.
My black cab driver the other day said, look, this is typical Labour. They are ramping up taxes and they're ramping up spending.
Did you refer to him to Sunak 21?
Good old Labour is what my black cab driver said.
You referred him then to Sunak 21 and Lamont 93, I imagine.
Oh, absolutely.
Told him to seek out the excellent story by Phillip Aldrich on the terminal this morning. Anyway, lots of fine print to watch, and we'll certainly pick up on all of those conversations around the budget when we get to them this morning. We have lots of those to come. One of those, in fact, shortly, Stephen Fine, the CEO of the UK investment bank Peel Hunt, will be with us. Definitely something to watch there in terms of the AIM tax treatment, in terms of inheritance tax. That's something that he cares a lot about. We'll broaden the conversation as well around the budget, but we'll certainly get his take there. And at the opening trade, so in around 50 minutes' time, we'll talk to Emma Wall, Head of Investment Analysis and Research at Hargreaves Lansdown. That, again, will have a budget flavour to it, along with a conversation with, of course, Philip Hammond, the former UK Chancellor. He'll be joining Lizzie Burden in Westminster ahead of the budget. And later in the programme, we will be talking to the CEO of the shipbuilder, Fincantiori. Really interesting conversation there, multi-dimensional, really, because on the one hand, you're talking about the luxury cruise industry. On the other, you're talking about defence and defence spending. And so we'll certainly get to the latter there in that conversation.
Yeah, and does there need to be more consolidation when it comes to defence spending and defence capabilities across Europe? So multiple different angles we can take with that guess. In terms of the daybook then, here's what else we're thinking about today. 10 a.m. UK time, we have Euro area GDP. We've already had French numbers out, slightly better than the estimates. We have German GDP out as well later today, expected to see a contraction there. 12:30 p.m. UK time. It is, of course, the big one. It's the UK budget. And we, the team, will be across all of that with the reporting, with the analysis, live coverage, of course, of that consequential event here in the UK. 1 p.m. UK time, German inflation data dropping. We're also going to be hearing from the ECB's Schnabel, Villeroy and Nagel as well speaking today. So a number of ECB speakers as markets continue to bet that the ECB will have to go pretty aggressively on rate cuts. But do they factor in a jumbo cut for this European Central Bank? And on the earnings front, as I mentioned, We have Meta, Microsoft and Starbucks, which, of course, has faced its own challenges. Those earnings dropping later today, so building out the story in terms of the corporate health of the US.
Coming up on the programme then, we'll dive further into US tech earnings following Alphabet's earnings beat as focus turns to those other Magnificent Seven members that Tom was just mentioning. But up next, we'll discuss what to expect from today's UK budget. We will be joined by Catherine Nice, Chief European Economist at PGIM. So we'll start on the budget, but also get her take on what's going on in the Eurozone with these growth numbers coming through this morning. If you have any questions for our guests, then please, you can get in touch with us. IB plus BBTV Go. That is the function to use this morning and every morning. This is Bloomberg. Welcome back, everybody. 7:16 here in London. So we're still some hours away from the UK's budget. We'll get to that in a moment. The US futures picture looks a little negative. We're busy digesting a whole host of earnings stories and some overnight conflicting messages, perhaps, from the tech sector. Let us talk about what's going on in the UK, though. The UK Chancellor, Rachel Reeves, is expected to unveil a major package of tax hikes and extra borrowing today. The much-anticipated budget will play a big part in setting the tone for British politics for the rest of the decade. Let's bring in Bloomberg's Lizzie Burden, who's in Westminster for us, and can set out, Lizzie, the big question: what is at stake this morning?
Well, Anna, this is Labour's first budget in 14 years. It's the first time that a woman is going to carry that famous red box. And look, Rachel Reeves herself, the Chancellor, has compared this to the famous Labour budgets in history: 1945, 1964, 1997. She says that it's time to rebuild the economy. But look, while we're at it with the historical comparisons, Rachel Reeves has waited longer than any of her predecessors in at least half a century to deliver this first budget. And so in those 117 days, she's been rolling the pitch, including for changing the fiscal rules to borrow to invest. So the question is, has that been enough pitch rolling to temper the market reaction? You saw gilts getting hammered last week. Is that the limit to what we see today?
Lizzie, what measures are we expecting, and will there be any rabbits pulled out of that metaphorical hat?
Well, Tom, Labour made some big promises in order to just get elected. They said that there would be no return to austerity, whatever that means, that there would be no rises in taxes on working people, whoever they are. Today, we're going to find out how far Rachel Reeves is willing to stretch those definitions. So one of the measures that we're expecting in terms of revenue raising is an increase in national insurance contributions on employers, not employees. That's expected to raise £20 billion. We're also expecting rises in inheritance tax and capital gains tax, which is controversial because Labour said that it wouldn't be raising taxes outside of those that were stipulated in its manifesto. The reason, though, that they're doing this is because Rachel Reeves also wants to raise spending on, for example, the National Health Service. But she wants day-to-day spending to be covered by tax revenue. Now, that's in the short term. In the longer term, as I say, we already know that she's planning to change the fiscal rules to borrow to invest. That would be £70 billion over the next 5 years. And on that front, the big question is, can Labour actually grow the economy? So this is where the fiscal watchdog's new forecasts, the Office for Budget Responsibility, putting them out alongside the budget, are going to be really interesting because, of course, Labour's top priority, it says, is to grow the economy by 2.5% per year.
OK, still ambitious, at least according to some takes. Bloomberg's Lizzie Burden on the ground for us, of course, outside Westminster, leading up to this really consequential budget out of the UK. Liz will be across all of that and reporting throughout the day, of course. Let's bring in some additional expertise right now. Catherine Nice, Chief European Economist at PGIM. Catherine, what are you and the team looking for in terms of the most consequential measures expected from this budget in terms of the impact on this UK economy?
So I think in terms of the impact from this budget is probably going to be relatively small. And I think the main question for outside observers is how much space does the Labour government unlock for the UK further down the line? So I'm really expecting that at this budget, they're going to remain pretty fiscally prudent, that we're going to see a combination of relatively tight fiscal and monetary policy for the UK over the foreseeable future, but that they paint the picture that in the not too distant future that we could see significantly more fiscal spending for investment. But that still will, be all to play for.
Well, I wonder how gilt markets should be thinking about that prospect then. How sensitive do you think the debt markets of the UK will be to this in the near and longer term then?
So there's been a lot of volatility around this point because we've been a little bit around the houses, haven't we, on this budget? Feels like we've taken ages to get here, and we've kind of flip-flopped around from, maybe the fiscal rule change will be something really quite small, a reversal to the change that was made only a couple of years ago under Rishi Sunak, to something that looks quite radically different from the sorts of fiscal rules the UK has followed before. But in terms of the commitments that they're making at this budget, our expectation is it's not going to be wildly different from a macro perspective from where we were in March, but that it really opens up this picture for the future. So I think that uncertainty is probably going to be with us in terms of bond market investor perspective for some time.
That's interesting, Catherine. So you're talking about the Chancellor giving herself headroom but not using it.
Exactly.
In the short term. Is that going to be crucial, do you think, to the way that gilt markets receive this?
I think it is a very important part of the overall signaling that we're expecting today, in that by doing that, she's going to walk this very fine balance between painting the picture for us that things are going to be different under a Labour government, that we are going to start to invest more here in the UK. But at the same time, we need to build the credibility in order to have the fiscal space to do that. And so giving yourself the space but not using it up front is a way of demonstrating that credibility, building up that credibility, and then hopefully you can use that space further down the line.
And a lot of people, some people have referenced the fact we've seen, to some degree, gilt yields on the rise into this budget, or at least spreads against some other European products. I mean, is that to do with nerves around what the budget might contain, or is that to do with inflation expectations and the extent to which the Bank of England will be able to cut interest rates? What do you put that down to?
I do suspect that there is a bit of muscle memory around this budget. But, the fact of the matter is that we have had to wait quite a long time for this budget. There have been quite varied views on what we were going to expect. And we only really got clarity from the Chancellor herself that we would be seeing a more consequential shift in terms of the fiscal rules. But up until that point, most of the people I talked to thought it was just going to be a tweak, similar to what we'd seen in the past. So I think given that uncertainty, it's not surprising that we've had this bond market reaction. And of course, we also have to remember the starting point. Starting point for the UK is we had a worse inflation problem than the US and the euro area. And I think that's also, feeding into a bit of the reaction.
So talking of the euro area then, how much divergence are you expecting to see in terms of growth across the major economies of the Eurozone as we look into 2025? We're going to get some data dropping later today. The French GDP came in marginally higher than the estimates. Are we looking at a divergent European economy next year?
So this certainly looks to be more and more likely to be the case. And it's a little bit unusual because we tend to think that, if the U.S. growth is really strong, that acts as a driver of global growth, and that can lift up a European economy that's very export-oriented and for whom the U.S. is, the #1 major export market. But it looks like now what we're seeing is the prospects of this divergence in terms of economic activity between the two regions. And, that is what I'm expecting to see in today's data. A big surprise, of course, would be if the euro area surprises to the upside and does a little bit better than what the softer indicators and what people are expecting.
Have you and the team been modelling the impact on Europe of Trump tariffs and what that could look like?
So we need to think about this clearly because the outcome is very uncertain, and you know, my view is that the delta in terms of the election outcome is probably a lot bigger for the rest of the world than it is for the U.S. and in particular for the euro area, just because the euro area is a very open economy, because the U.S. has become an even more important partner in Europe really over the last 5 years. And, you know, it's starting a bit on the back foot. You had some comments about Germany, and that could make any kind of negative impact from tariffs much worse. So we do have to think about these things, and I think the bottom line is that renewed tariff wars is not good news for the euro area.
And so, Catherine, how much visibility do you have around the scale of the cuts we're going to get from the ECB? Because there's now quite a live conversation about whether we get a 50, for example.
So I think we need to understand that this is a different governing council to the one that we had before the pandemic. I think there's been a fundamental shift, that this is a more proactive governing council that is going to, you know, yes, they have a single mandate, but in practice, they're essentially following a Taylor rule, i.e. they are essentially putting the same amount of weight on activity indicators that you see in the U.S. when it comes to making interest rate decisions. And so I think it is not implausible at all for the ECB to cut 50 basis points in December, again at the end of January, and they are, boom, top end of neutral at the beginning of the year. Okay. And then they can sit tight and see how things go from there. OK,
but that's quite active then in the short term. Catherine, thank you very much. Thanks for joining us. Catherine Nice, Chief European Economist at PGIM, with thoughts on the UK budget and the wider European growth story. Coming up on the programme, we'll get back to that budget conversation here in the UK. Peel Hunt's CEO, Stephen Fine, will be joining us to discuss the budget, what it could mean for the investment landscape. Specifically, he has thoughts, of course, on inheritance tax relief on AIM-listed companies. Is that going to be something that the Chancellor is going to take aim at? We'll certainly make that part of our conversation. This is Bloomberg. Welcome back to the programme. 30 minutes until the start of trading here for European equity markets. Let's focus in on the futures picture, shall we? It looks kind of negative this morning, in fact. Certainly the European one, at least. Euro Stoxx 50 futures down 0.4%. CAC 40 futures weaker. We've had some perhaps negative corporate earnings stories out this morning, which we factor into an Asian picture, which was already a little weak, down by 0.2%. Looking ahead, though, the US futures picture looks just a little brighter. Nasdaq futures up by 0.3%. E-minis up 2 cents. We have a lot of corporate earnings, of course, stateside as well, a lot of tech news to factor into markets. Back to the bond story, and of course, we're watching the GDP numbers come through for Europe so far this morning. We've had French GDP growing at 0.4%, a little higher than had been expected. We'll build a picture of the Eurozone growth story as we work our way through the morning. We'll certainly keep an eye on gilts when they open up at the start of trading in around half an hour's time for that UK perspective. But this is the picture across the bond markets here in Europe, where you see very slight movement in curves. Let's talk about the UK. UK Prime Minister Keir Starmer has pledged his government will embrace fiscal reality in today's budget. Earlier this month, he told Bloomberg at the UK Investment Summit that his government is focused on growth.
Economic growth is the #1 mission of this government, and that means that we're open for business as a country. We want to drive that investment into our economy, and we want to see that in jobs, secure jobs, in different parts and all around the United Kingdom. And I think quite a lot of the inward investment decisions we've seen, running into tens of billions, are indication, if you like, of the approach that we're taking in partnership with the investors and the businesses.
Let's get another perspective on the outlook. Stephen Fine joins us, the CEO of Peel Hunt. Really nice to have you with us this morning. Stephen, can we start with the big picture then? We were listening to the Prime Minister there talking about wanting to be open for business. Is that something that you're expecting to see demonstrated in the budget today? We've heard overnight that Rachel Reeves will be talking about invest, invest, invest. Is that going to be the big picture takeaway from the budget, do you think?
Thanks very much for having me. Look, I want to be optimistic here, and I do really believe that the stars are potentially aligning for the UK market. The inflation picture, the growth picture, the stability of government, the centrist attitude. I've never known such a level of expectation or anticipation around a budget, though, and I'm just hoping that the let's call it the trashing they did of the UK macro picture post-election has been perhaps one of the best exercises in expectation management. And they'll just deliver better than the current negative expectations.
OK, so you think that maybe that was the purpose of some of that negativity. We'll see if it delivers.
That might be a bit too clever, but I'm hoping they get a bit lucky here.
All right. Let me ask you about some of the specifics. Let's dive into some of the specifics around the budget, because I know you have specific thoughts on them.
Yep.
In particular, the AIM-listed market, the alternative investment market here in the UK, typically featuring small businesses, startups, some of them technology-focused, other industries as well. And there is currently a tax relief that those who pay inheritance tax can get in connection with holdings in AIM stock. What are your concerns around changes that the Chancellor might make there?
The concerns are the removal of that inheritance tax break. I think the market has priced an awful lot of that in. We worked out and modelled that would be maybe a 20 to 30% level of underperformance in the AIM index. You've seen it underperform the main market by about 6% versus the indices rallying 6%. So you're already sort of 12 to 15% underperformance already on AIM. And there is now a deep-rooted reticence to maybe even commit funds to equities on that platform, given the uncertainty over this removal of this particular break.
So if she doesn't do it, we could see a bounce back in AIM stock.
You could see a bounce back. I think that would be welcome. My concern, though, is that the die is slightly cast in that they haven't done it now. It could happen in the future. That's always a worry.
But these, I mean, the problem is, some would say, that these are the kind of businesses, these are the kind of technology business, the kind of innovative businesses, the smaller businesses listed here in the UK. They're going to drive that innovation, that growth in the future, and you're kind of kneecapping them at this stage. Would be the critique. How do you think? Is that a fair analysis of the risks around this?
I mean, one of the problems is we have an incredibly good venture system. We're very good at angel seed venture, Series A, Series B. But unfortunately, when you get to a certain scale,
we don't have growth
size, you tend to find the investors come from overseas. You end up with US investors on your cap table. That means when you get to the pre-IPO stage, the likelihood is that you may well list overseas rather than here, or you may choose to stay private. And one of the consequences of the era of free money, where I guess private markets boomed, is that the de-equitisation we've seen in the UK public markets. 90 companies have left AIM. I think 20 of our FTSE 250 are likely to have left this year alone, which is quite a staggering number. The desire for companies to remain here, use the capital markets to best effect, use AIM, use the main market, grow, and find access to capital is just concerning.
Does the government get it? I mean, when you have conversations with them, do they understand the need for this support, the need for this segment of this economy to drive growth into the future?
I mean, look, it's not just AIM. I think it's a public market debate. I really do think it's a public market debate. And it's not just a UK problem. I think there are 50% less public companies in the US. You know, NASDAQ NYSE is something like 70% of the market cap of all the world's exchanges put together. So there's a huge draining of resources to the US. The one thing we've been very keen to press is to try and put some form of plug in the bottom of the bathtub to stop the exodus of funds leaving the UK. And whether that's retail funds, whether that's pension funds, we give tax breaks to allow people to export their capital to overseas. It kind of seems a bit crazy. So these things we've been clamouring for.
But I suppose if you're a saver and you think, or your advisors think, that the best opportunities and the AI growth is being driven out of Silicon Valley and not here in London, then that's why that money leaves, I suppose, Stephen. And so is it difficult to find products that will encourage money to stay, or you think it's actually quite easy?
I don't think it's that difficult. I mean, normally the best incentives tend to be sort of tax-driven, when you look at it and think, OK, where can I get the best opportunity for my savings, for my wealth, for my growth opportunity? So, I think these issues, particularly for the drain of pension fund money, which is an area that we've been quite focused on, is quite alarming. And I think we're delighted that you now have a pensions minister in Emma Reynolds, who straddles the Treasury and Department of Work and Pensions, to actually look at this and look at the potential reforms that may well be needed to change that outlook.
Back to the budget, on the capital gains tax side of things, and whether we might see that an increase in taxation on shares, for example, in other places away from some of the AIM changes and inheritance tax we were talking about. Is that something that's shaping behaviour? Do you see evidence of that already?
Definitely. I mean, you can't say we want growth, and then cut the hand off the hand that feeds you. So, stifling capital gains tax, taking away inheritance tax breaks, preventing innovation, creativity, etc., are just not good for growth. So I'm hoping that the government have been listening to these issues and can see merit in it.
Give us a sense then of what entrepreneurs CEOs, investors are telling you on that front when it comes to that proposed change in capital gains tax, potential increase in capital gains tax, and the carried interest piece as well for private equity? What are you seeing specifically in terms of that entrepreneur behaviour?
If I look at entrepreneur behaviour, if I just go back to, say, public markets, there's actually been a reasonable amount of secondary share issues this year. IPO market has been very quiet, moribund, which we know maybe we can talk about, but the secondary share sale market has been quite good. And that's actually been driven mainly by founders taking some of their chips off the table in anticipation of what may or may not happen. And I can't say in the environment, because of the rhetoric around it, you can necessarily blame them. Now, if it doesn't happen, or if the rise in capital gains is more moderate, which I'm hoping, then I think that can be seen as, OK, that's actually not such a bad place still.
OK. Stephen Fine, thank you very much indeed. CEO of Peel Hunt, on some of the concerns leading up to this budget, the opportunities as well for this UK economy, particularly when it comes to public listings. Thank you for your time, for joining us around the studio this morning. Some redheads crossing the terminal just in the last couple of minutes. This is part of a divestment from Ørsted, of course, the operator of wind farms, selling a share of 4 UK offshore wind farms for a price tag of £1.75 billion, and that is to Brookfield. So Ørsted selling a stake in parts of the UK wind farm business, again, to Brookfield, £1.75 billion. We'll watch that stock at the open, of course. Coming up, UBS smashes expectations while VW misses as margins get hammered. A lot to go through then in your stocks to watch. That is next. This is Bloomberg.
I'm very pleased with our growth. This business has real momentum, and the overall opportunity is increasing as customers embrace Gen AI. We generated Q3 revenues of $11.4 billion, up 35% over last year, with operating margins of 17%.
Alphabet CEO Sundar Pichai, of course, speaking during the company's earnings call. Alphabet shares rising post-market trading after its cloud computing sales beat on signs that its pricey AI bet is paying off. Let's dive deeper into this with Bloomberg's Newly Pernell then. Newly, the concerns, the question marks, of course, amongst all of these hyperscalers is to what extent that CapEx spend on GPUs, on data centres, is actually paying off, to what extent they're getting the monetization in terms of AI. Have they made any progress in reassuring investors that that story is coming good?
That's right. As you say, investors have been waiting to see, are the billions of dollars that Google is pouring into potential AI businesses going to pay off? And today, they got an interesting answer. The number that jumps out, 35, that's the percentage that Google said it saw in sales growth for its cloud business compared to a year ago. And it cited some AI services as part of that cloud segment. So I think investors probably saw that, and that's the reason we're seeing an uptick in the stock.
Newly, we've also seen Google recently, of course, fall under antitrust scrutiny, breakup being mentioned as one of the possible remedies in one particular case. Did the company say anything about that?
Mm-hmm. Yeah, well, Sundar Pichai, CEO, was asked about that on the call, and he said, essentially, we like to keep our products open to everybody. The market shows that people want to use our services. That's why they're so popular. But he did say that depending on how the U.S. government moves forward, there could be what he called unintended consequences for U.S. leadership in tech. So that was, he didn't elaborate on that, but that's what he said when asked about that. And I think investors were probably watching, given this ongoing scrutiny over their business, could Google execute? And certainly the cloud numbers show that they're doing quite well in that respect.
So, Newly, to the hardware piece then, particularly those AI accelerators, AMD coming out with earnings that they actually beat in the quarter, but it was the forecasts that seemingly kind of disappointed investors. What was the story with AMD?
That's right. Well, analysts expected on average that they would forecast $7.55 billion of revenue. and they came in with a forecast of 7.5 billion revenue, so that was a slight miss there. You know, investors have been watching to what extent can the company increase demand for its so-called AI accelerators. These are the most sophisticated kinds of chips that the likes of NVIDIA make that help train AI systems. And so NVIDIA has been working to try to grow that business. It's sort of seen as a bellwether, the demand for that sort of chip for the amount that companies really want to invest in AI. But it was that revenue miss, that revenue forecast miss that seems to have moved the stock.
OK, thanks very much. Thanks for the update. Lots to talk about there in tech this week. Bloomberg's Newly Purnell joining us there from Hong Kong with the latest on some of those US big tech themes. Let's think about where we are on broader markets now. Bloomberg's Rachel Evans joins us to talk about the markets in 3 minutes, managing editor for FX and rates coverage for the US and EMEA. Rachel, we are sitting here in London, so I feel contractually obliged to ask you about the budget, around positioning ahead of the budget. I mean, are we seeing nervousness in gilt markets, in the pound? What's the setup?
Yeah, so I mean, that definitely feels like it's the big story of the day for markets, certainly this morning. Looking at kind of where we're at in UK assets, we've obviously seen the pound had a very strong run after the elections in July, but that's now slipped off. It's from its two-year high. Gilts have been under a little bit more pressure over the last month, particularly looking kind of at the spread of gilts to their safer peers like German bunds. So that's kind of something that we're watching. And stocks have been kind of trending sideways really since April. And I think what that tells you is that, you know, investors are really looking for a reason to re-establish some of their bullish bets on the UK. Like coming into the election, there was a sense of kind of change and that, you know, this was going to be a new era for UK and potentially UK assets with more stability for those markets. But now we need to see whether the UK government can deliver that in the budget. So I think those are where we're at in the assets, but the bigger issue is really going to be this reputational one. Can the UK once and for all draw a line under kind of the Liz Truss era, as it were, and show that it is open for business and a place that investors can trust? OK,
so we focus on the reputation issue for the UK on the back of this budget. Currently to the US, 424 right now in the US 10-year. So some moves there, yields lower after they got to, what, 434? What's the story around the debt issuance in the US and how that played into the bond markets yesterday? Yeah, so we've obviously had quite a few auctions this week. We've seen 2, 5 and 7-year debt sold. But today we also get the Treasury's quarterly refunding announcement. This is basically where they come out and say, here's how much debt we plan to issue over the next 3 months. And we're expecting to see them announce $125 billion more of debt to be issued. That is in line with what we've seen in recent quarters. But the big question is really about how they communicate what is next. Because they've been saying in the last few announcements that they plan to keep sort of their auctions steady in coming quarters. But we have an awful lot of uncertainty coming through in terms of government spending plans, given that we have, of course, the US election next week. So there's that huge uncertainty kind of hovering on the lines. So I think it's going to be very interesting to see how they communicate that, how much they are prepared to say we're going to keep things steady for quarters, you know, still to come, when they don't really know, you know, who is going to be in the White House and how that is going to affect spending plans.
The yen. Almost as flat as it's possible to be against the dollar right now, Rachel, but that is not always the case. We have a BOJ meeting tomorrow, don't we?
We do, yes, and I think the communication piece is going to be key there. No one is expecting there to be a hike, but when we look at the yen, we've seen you know, the yen weakening back towards levels where prior to the BOJ's last hike back in July. So it's going to be a real question of to what degree they indicate more hikes to come in December or January.
OK. Rachel, thank you. Thanks very much. Rachel Evans, Bloomberg's managing editor for FX and rates coverage for the US and EMEA, taking us on a bit of a tour of some of the themes that they are watching in markets. Let's go back to the corporate news flow. Joe Easton from our equities team has a briefing on stocks in focus. Good morning, Joe.
Morning, Anna. So UBS absolutely smashing forecasts in their latest earnings report from the banking sector today. Net income at $1.4 billion. The estimate below 800 million, so massively above what the market was looking for. Wealth management holding pretty steady, and importantly, the return on tangible equity, one of the numbers all the analysts look for, almost double what the market was looking for on that number as well. So really strong on those lines. We can see that UBS has had a bit of a volatile year-to-date, bouncing around, given that some of their earnings reports haven't quite met expectations, and also some volatility in banking, given the monetary policy outlook and the changing effect of that. So this is going to be a key stock to watch today. We can see 5 sell ratings, actually one of the highest sell tallies among European banks. So some analysts not yet convinced on the outlook for that one. Then over in chips, we got ASM. This one looking really strong as well. Now ASM is bucking the downturn in the chip machinery market, according to analysts over at Citi. They say the firm is weathering well the current storm in the semiconductor capex industry, according to analysts over at Citi there. Their outlook looks pretty steady on all the numbers, including the orders in chip machinery for that one. But the other negatives from the sector are coming from the US, as one of your guests was explaining a few moments ago. We had those big US names dropping. ADM, now bear in mind AMD, that is a $270 billion company, and it was down almost 8% in the aftermarket. And Corvo, which is much smaller, but fell 17%, and that actually hit some Apple suppliers in Asia overnight as well. So potentially there might be a read-through onto the broader chips as well. Then in terms of VW, Volkswagen, this one is a bit of a miss in terms of some of the margins, and the headline numbers were really well below what analysts were expecting. This great chart here shows that margins were at their lowest level since the pandemic days. We can see back in 2020, so a big drop down given the weakness in China for that company in terms of what's going on there. The other thing to note, of course, is the headlines around tariffs between the EU and China. The EU looking to impose more tariffs or higher tariffs on Chinese electric vehicles. So we'll have to see, could that be a positive potentially for some of the names like BMW, Mercedes, Stellantis, but obviously the VW numbers are going to be key today. Then finally, on your ratings, we've got some interesting ones. LVMH gets a new buy. That's as Berenberg has a big note on luxury. They've got a lot of new ratings on that one. IAG is a new buy at Jefferies. They've got a big note on airlines, so lots of ratings from them. And Lloyds is cut to equal weight of Morgan Stanley, who says the company will do fewer share buybacks due to last week's motor finance ruling that we have been covering. So that one could be a bit of a weak one this morning.
OK, Joe, thank you very much. Equities reporter Joe Easton, really busy this morning with a host of companies to talk about. Tom, and that leaves some for us to pick up on as well, because we had numbers at the top of this hour from GSK. We'll see if we get much movement in the shares, but it was a sort of a mixed picture in a sense. The EPS number for the third quarter came in better than expected. That's backward looking. They are sticking to their guidance overall, but a couple of the core drugs that were being watched didn't live up to expectations. So we'll see how the market deals with that one. But that's certainly one that's in focus. BASF also caught my eye as well. And this was a story of weakness, guiding lower. The new CEO joining in April, though, and rethinking the strategy, big focus on cost cuts. So, you know, maybe some of that is in the price, but we'll see how much that moves.
Yeah, and that's a company with major exposure to the Chinese market, of course, but also the industrial sector, autos as well, in terms of some of their key clients. So they have faced, obviously, the challenge that's come through across that part of the global economy as well. Talking to GSK, the stock is up about 3% year to date. And yes, they were talking about some of the vaccines around shingles and some of the respiratory virus medications they have. The other story on the banking space, so we have UBS, massive beat coming through there. Standard Chartered, really interesting, of course, with that exposure to EM and Asia, coming through with some growth outlooks when it comes to the Asia story and the wealth part of that business. Speaking to the CFO there, seeing real opportunities when it comes to driving growth in wealth for Standard Chartered, and also, importantly, upping their forecast around return of cash to shareholders from $5 billion US to $8 billion in terms of buybacks, for example, by 2026. And he suggested to me they could maybe do more than that as well.
And the stock up in Hong Kong, crucially, so we'll expect that one to follow higher in the London session. Campari could also be a mover, missing on profits, the outlook coming in below estimates as well. We also need to tell you about something else that is of interest to terminal users.
Bloomberg terminal users. There we go. Thanks for the segue. They can already message us, and I'm sure they do, with questions and comments. But we would like to hear from all of our viewers. So we've put together a helpful short online survey. Click the QR code on screen now to tell us what you'd like to see more of on Bloomberg TV and anything you would change, apart from the anchors. We will use your feedback to make the best programmes we can.
Excellent. Right, the futures picture for Europe then does not look that excellent. It looks a little negative, perhaps weighed down by some of the earnings stories that we have been talking about. Not UBS, that one looks good, but some of the other themes. We are focused on some futures in the States that are lifted perhaps by alphabet sentiment. The open here in Europe is next. This is Bloomberg. Welcome back to the opening trade. A few minutes to go until we get that opening trade here in Europe for this Wednesday morning. Let's have a look at the setup then going into today's session. And we have some big events still to come. The UK budget is, of course, amongst them. But with that in mind, heading into the session, this is the picture for European stocks yesterday. We saw banks and basic resources doing OK yesterday, but travel and leisure stocks were under pressure, and we saw some downward pressure on European stocks throughout the session. In contrast, US stocks showed some upward momentum. So we did seem to see quite a divergence in performance in yesterday's session, and under normal circumstances you might have thought that positivity in the US might deliver something for Europe this morning, but that doesn't seem as if it's going to be the case. We did see a bit of a drop-off in US trading. After hours we also got those Alphabet numbers. They were pretty positive. The AMD numbers maybe a little bit less so, but tech aside, perhaps we are expecting, and if we put up the futures picture you'll see this, we're expecting to see some negativity at the start of the European trading day. So we could be down 0.7%, for example, on the FTSE 100, around 0.8%, 0.7% lower on the CAC 40 as well. So weakness perhaps at the index level for European stocks then, Tom?
Yeah, and a divergent picture when it comes to the earnings story as well, with the banks outperforming, the likes of Standard Chartered and UBS coming through with some pretty decent beats, of course, in terms of the top line on the earnings story, but the concerns around VW. So on UBS, the group posting third quarter results, broadly beating expectations. As I said, they saw net income at $1.4 billion. That was well above the estimates, almost twice the number that had been expected by analysts. VW expected, of course, to come through with a soft print, and they certainly did. The operating margin shrinking to the lowest since the COVID-19 pandemic level. They have conversations with Labour and Union right now, of course. Chip stocks also in focus on the back of AMD, Anna.
Yeah, absolutely. On the back of AMD, we had ASM International reporting as well, not to be confused with ASML. It's about 10 times smaller. But we'll focus on all of that at the start of the trading day. And the FTSE 100 is flat at the start of the trading day. A little bit of downside, though, coming through. And as the futures picture had indicated, we are expecting to see some quite considerable weakness across European equity markets this morning. The Stock 600 then down by 0.3%. The IBEX delivering to the downside, down by 0.4%. So on the one hand, you've got some quite positive individual stock stories, the likes of UBS that we were just hearing about from Tom, and on the tech side, the Alphabet story, parent of Google, that looked to be pretty positive, what AI is able to deliver for their cloud business. But here in Europe, maybe some of the earnings stories a little bit disappointing. We'll see how VW is digested by the markets, how GSK is digested by the markets, these heavyweight names. We'll see what kind of pressure they put on the indexes. So the FTSE is down, the CAC 40 now open and down by 0.8%. The Xetra DAX down by 0.4% then, Tom.
Here we go on the sector breakdown then. Not a major surprise that autos is leading the losses as a sector. Just in the opening few seconds, of course. Currently that sector down 1%. VW certainly part of the story there. The disappointment, of course, not unexpected, but just the scope and scale of the losses, or at least the challenge coming through from VW, really pronounced in those margin story. So autos as a sector currently down a little over 1%. Travel and leisure also taking a hit, off by a similar amount. A consumer, so the luxury space is part of that mix, currently down 0.8%, and then basic resources also lower by around 0.8. Just one sector in positive territory right now, and that is the retail sector. Next gaining here in the UK session, currently up 2%, Anna.
Yes, and I think we had some numbers out from Next at 7 o'clock this morning, didn't we? Which perhaps should have been on our radar, but we did get some pre-tax profit a little bit above estimates, full price sales, coming in above estimates as well. So not quite so much discounting in that sector. They're anticipating an enduring pre-tax full year above £1 billion, it seems, one of the lines coming through from Bloomberg Intelligence this morning. So that's what we see across these markets. Let us take a listen to some of the conversations we've been digesting coming to us from Riyadh. Interesting one around cash and cash on the sidelines. Let's listen to what State Street CEO Ron O'Hanley, speaking to Bloomberg, had to say. And he was speaking from the FII conference taking place in Riyadh.
Investors are sitting on a lot of cash, and what they wanted to see was what was going to happen with interest rates and the intersection of interest rates in the economy. And so there is that cash on the sidelines. It's down a little bit, but your point's well taken that there's still a lot of cash, which we see is an opportunity for markets going forward. That market, as interest rates decline, that those volumes ought to go down as that money seeks higher returns.
Let's speak now to Emma Wall, Head of Investments at Hargreaves Lansdown, who's with us on set this morning. Good to see you, Emma. Nice to have you with us. So there we were listening to sort of global perspective, cash on the sidelines. As interest rates come down on that cash, perhaps some of that cash is put to work elsewhere. I suppose in the UK we've got an added dimension to that conversation in that the budget takes place today. So maybe people have been holding fire with whatever it was they intend to do just to see what the budget throws up. How are you approaching the budget today? What are you thinking about?
Well, there's two parts to this, right? There's what our clients are telling us they're nervous about and what their behaviour has been, and then what we expect from the markets. And actually, from the markets, it's kind of the same story that we began to see at the election. So, you know, Labour has been pretty vocal throughout the campaign to elect and since on the types of business they'd like to support. So it's the green economy, it's more house builders, it's being tough on oil and gas, being tough on water companies who haven't been kind of fulfilling their duties in terms of clean water. It's also things like infrastructure spend. So that is kind of more of the same. And we do expect some positive uplift, although it be minimal from those sectors today if you expect to see that commitment to spend. Well, what there has been such a theme in our conversation with clients and indeed across sentiment actually for businesses and for investors has been this uncertainty. What is going to happen to taxes? And actually that's been more a driver of our client behaviour than it has been an expectation on what parts of the market will do well and indeed which parts of the market may do less well because of some of the policies out today. The curveball in that, it's interesting to see the retail and leisure sector sell off a little bit, is what we've heard in the last 24 hours around minimum wage, around living wage, because actually that's a later piece of information that we do expect to impact those types of businesses, those which are, of course, very labour-intensive, that can't be done remotely. And so actually we will begin to see some policies today that may surprise, and then, of course, we will digest and see what it means to the markets.
It's interesting because you could look at that policy and, regardless of the rights or wrongs of it, say, well, will that add to inflation risks, I suppose, here in the UK? And thinking of that and the way the gilt market has opened up this morning, I suppose this was in the conversation yesterday a little bit as well. But we have the gilt market kind of moving in the same direction as the rest of the European markets, but actually gilt yields coming down a little bit this morning as we head into the budget proper. In terms of gilt markets, are you poised for volatility there on the gilt market story? I mean, there isn't an expectation that we relive the Liz Truss era, but we have short memories and investors remember this stuff.
Yeah, I think the gilt market's come off a little bit today, in part because of sort of normalisation of how much it's bumped up in the last week on that news that the way that we calculate debt in the UK will be changing to take into consideration liabilities and assets. So, of course, on expectation of much higher borrowing because of that recalculation, you saw the gilt market could significantly, in terms of yields, come up over the last week. Now, so, I mean, in a way, that was very clever because you got some of the news out ahead. If you're announcing that today, along with other packages that perhaps meant more borrowing, then you perhaps see gilt yields fly higher. Again, though, it comes back to what does it mean for businesses and what does it mean for people and what does it mean for growth? I think it's really interesting that we had the IMF figures out last week, which actually upgraded growth for the UK from 0.5% to 1.1% for this year. But those were off the back of calculations done under the former government and on the expectation that yields would come down, that the Bank of England would continue to cut, which, of course, may no longer be the case after today.
So you think the BOE could be challenged in terms of its rate-cutting expectations, rate-cutting cycle, because you maybe get a more fiscally stimulatory budget today? That could prove a challenge to the BOE. Where do you want to be sitting, then, when it comes to gilts? Do you want to be at the front end, the long end? Where is the opportunity in UK sovereign debt?
I mean, I suppose it's worth saying that, you know, higher gilt yields, if you're looking for income, is a positive thing. It may be signalling that we're expecting inflation to stay sticky. It may be signalling that we're expecting borrowing to go up. But actually, if you're a buyer in this market, it's a really nice price to be locking in. So we are actually saying that a diversified approach when it comes to all fixed income. We've recently sat down and begun the very difficult task of doing forecasting for 2025, particularly difficult when you're doing it in October before a budget and indeed before a US election. But we like to begin these processes early. And we're still pretty bullish on fixed income because on a 5-year view, you know, you are being paid for risk. You don't even have to go too much into high yield to get some pretty juicy returns. And with inflation having come down, although, you know, it could be sticky depending on what happens today, you are still getting a real rate of income. So we're pretty bullish on fixed income on a 1-3-5-year view. Yeah,
the 5-year currently offering you 4.14 to that point. Yields are currently down about 4 basis points across the curve, 5 basis points, in fact, on the 10-year. So there is that bid for gilts today. We'll see how that adjusts around the budget, of course. When it comes to that 2025 view that you and the team are building out, on the equity front, Where does that take you? What are you looking to lean into? What do you want to kind of unwind from as you look into next year?
I mean, some of it is a continuation of this year, and I would also say, obviously, investing is about more than a year. It's about long term. But, you know, we are definitely saying that actually we do think it's time to continue to take gains out of the US large caps, particularly within the sort of that tech story, which, although has been more volatile of late, certainly on a 1, 2, 3 year view, you're looking at considerable gains. We think there's some really interesting opportunities within US small caps. I mean, obviously, you have got an election in the next week, which will have an impact. But we do think actually both candidates seem to be supportive of that part of the market, whether it's to do with kind of less regulation around Donald Trump or to do with sort of pro-growth, to do with some of Kamala Harris. So the US small caps on a valuation basis and on a political basis we think could be positive, you know, whether that's, as I said, on the basis of trade tariffs or just supportive measures.
Yeah. It's interesting you mentioned US small caps as one of your sort of areas to lean into for next year in the context of where we started the conversation on the budget. And we talked to Pell Hunt's CEO in the last part of the programme, and he was saying, you know, he'd like to see more money that's invested in, well, more British savers' money staying in Britain. There are different ways to think about that. Either, you know, you need to create more startups and more tech firms and encourage that money to just stay here, or you can maybe put tax incentives around keeping that money in the UK. Is that something that you think the Chancellor will lean into today? It's something the last government tried to do.
Yeah, I mean, there's a couple of policies which we'd look to see clarity on today. Obviously, the British ISA was something that was mooted under the last government. This government has been less supportive. I expect to see some sort of conclusion to that today. It's very difficult because this government has been very clear about its focus, and its focus is working people, a phrase which, if you've been following the kind of news headlines, has drawn a lot of, well,
heat.
Yes, because of the interpretation. You know, one of the things that was clarified last week is that the Prime Minister doesn't consider people who draw income from investments to fall under that classification of working people. So I definitely do think that, you know, the UK needs support in terms of encouraging more listings, in terms of encouraging more investing. You know, our entire modus operandi at Hargreaves Lansdown is in order to get retail investors to invest more to secure their financial future. But the policies that will be announced today may or may not be supportive of that, because I'm not sure it is the focus currently of the government.
Yeah, the critique would be that working person definition is a kind of very 1970s kind of blue-collar approach to what a working person is. Thank you very much indeed, Emma Wool. Really interesting in terms of how to position on the back of this budget that we, of course, will be getting later today, and that exposure continued to the US with a view on small caps. Head of Investments at Hargreaves Lansdown. Thank you. A couple of lines crossing when it comes to the Spanish economy. Prelim third quarter GDP rising 0.8% quarter on quarter, so a growth of 0.8% for GDP out of Spain, versus the estimates of 0.6%. So coming in higher than expected. And the Spanish growth story continues, particularly that divergence between Spain and some of those core European economies, France and Germany. Slightly different picture, a brighter picture over in Spain as well. Inflation coming basically in line with expectations on terms of CPI out of Spain. But the growth picture, GDP in the third quarter, in terms of year on year, 3.4%. The estimates have been for 3%. So 3.4% growth in the third quarter for Spain. That's prelim. Let's check in on your core 6 stocks then in Europe for the moves today. The standouts coming in terms of the downside for Nestlé, with that, of course, exposure to the consumer, currently down 0.7% on Nestlé. The one stock in our core 6 that remains in positive territory is Schneider Electric, posting gains just modest 0.2%. A big hit, in fact, coming through for LVMH. Once again, the luxury space under pressure, down 1.2%. So that's the biggest loss leader across those key 6 stocks that we focus on a daily basis. Let's cross over to Joe Easton right now, standing by for some of the movers beyond those core 6. Joe, what are you looking at?
We mentioned LVMH there, Tom, and I suspect this might actually be a read across from the drink sector today, because we got another profit warning from Campari last night over in Italy. Now, this is the maker of Aperol Spritz and a bunch of other brands in the drink space, really getting hit hard as they downgrade their earnings guidance once again on weaker sales. Analysts predicting double-digit downgrades for the company, and that is feeding through into the other drink stocks. As we can see, Pernod taking a hit, Diageo, Carlsberg even down in the beer space, and I suspect the LVMH drinks part is also exposed to that. So potentially that's the reason for that one. Then one stock going exactly the other way is Puig. Now, this actually IPO'd only in Spain around 6 months ago. One of the biggest IPOs in Europe this year. It's the maker of perfumes. They do brands like Charlotte Tilbury and Jean Paul Gaultier, reporting really strong sales, and that stock gaining as much as 12% at the open in Madrid this morning. Pretty decent move for that new listing on the market in Spain. Then in terms of banks, UBS, that one is rising around 3.5%. Now, we did get some really big beats on a lot of their numbers, including the net income, as we flagged earlier. Also, their return on equity looking strong as well. And Stand Chart pretty much mirroring what we've seen from the other Asian peers in terms of their earnings, looking pretty good on the net interest income as well for that one. Then in the UK, the one standing out, all these down the bottom here are green, but take a look at Glaxo, falling as much as 3%. A lot of this is due to their vaccines. Weaker than expected vaccine sales in shingles is what analysts are pointing to. Apparently, this is mostly focused in the US, but we can see the other firms you mentioned next earlier getting a bit of a boost there. Glencore in mining as well. Aston Martin, that stock is obviously down sharply over the past couple of years, but rebounding following some pretty strong sales from those companies. We will have a quick look at autos. Now, surprisingly, Volkswagen actually is in the green. They did have that weakness in the margins, but we're seeing peers declining. BMW, Stellantis and Renault. Remember, we got the headlines around the EU tariff situation. I'm not sure, maybe that's potentially having a bit of a read-through, a bit of an impact on the broader sort of trade on that sector at the moment. But Volkswagen holding up pretty impressive, up 1%, actually outperforming at the moment. Finally, just to check in on Lloyds, it's been a terrible 3 or 4 days for this stock. It's down around 12% since Friday on worries about this motor finance ruling from the Court of Appeal. And as I mentioned earlier, Morgan Stanley downgrading the stock, saying that Lloyds will have to reduce their share buyback by around 500 million, according to their estimates. That one hitting Lloyds again, another bad day for that stock. And we're also looking ahead to the UK budget later.
Of course we are. Joe, thank you very much. Joe Easton from the equities team. Coming up on the programme, we'll get back to those numbers out of UBS. The UBS third quarter earnings beating expectations. But the CEO, Sergio Ermotti, says the macroeconomic outlook for the rest of the world is, quote, well, it remains clouded. We bring you more from our interview next. This is Bloomberg.
Consolidation, it's necessary in Europe for banks. I think that it's very difficult for banks to sustain the economy, to sustain all the investment needed to go through the reforms necessary for Europe to flourish again.
That was the UBS CEO, of course, Sergio Ermotti, speaking to our colleague Francine Lacroix. UBS shares higher than this morning in what is, broadly speaking, quite a negative market, as the Zurich-based bank posted third-quarter results that broadly beat estimates, and in some cases beat estimates by a wide margin. Let's head over to Zurich now, bring in Bloomberg's Francine Lacroix, who has been conducting that interview for us, poring over the details of these earnings. Fran, good morning again. So the integration then of CS is going ahead of plan, it seems. What does it mean for acquisitions and for buybacks, the fact that they think they can sort of digest this business so quickly?
Good morning, Anna. So he was very clear, like he said just a couple of weeks ago, that they're about 6 months ahead of the planned integration of Credit Suisse. I have to say, if you look at the results, everything seems to be going okay. A couple of questions maybe on capital, which we'll get back to. But if you look at net income, almost twice what analysts had forecast. The continued client momentum of net new assets is also coming in. The integration, as you say, of Credit Suisse is on track. What that means is that they're sticking to their plans for dividends and share buybacks. What that also means is that there are a lot more question marks, I guess, about whether it means that they can do an acquisition earlier than expected, whether it means that they can actually increase share buybacks and dividends. I think there are a couple of questions going forward in terms of the fourth quarter, but overall this was a strong set of results. The one, I guess, caveat was capital, because capital was down compared with the last quarter. Again, we understand that UBS actually chose to phase out this regulatory benefit as a result of a takeover of Credit Suisse. I don't know whether it's a bargaining position also with the government, given there's new capital requirement rules coming into place, which we don't know exactly when that will come or the amount of them yet.
Yeah, that tussle continues, doesn't it, between UBS leadership and the government of Switzerland, of course, in terms of the capital needed. So the stock up 3.6% so far in the session, close to 3.7%. So investors rewarding, as you say, a pretty decent set of results. When you spoke to Ermotti, Francine, what were your takeaways when it comes to his concerns, though, about the future? What he highlighted in terms of some of the future risks?
Well, he definitely talked about the U.S. election and question marks over the fourth quarter. Now, he says, look, the fourth quarter, just because of the seasonality, is usually a little bit weaker. But also, he was very careful in saying we don't know what happens in the U.S. election. There are a lot of geopolitical concerns. We don't know what it means for unwarranted, I guess, volatility. We don't know, what happens also to client behavior. Now, we have been briefed also about some of this. Everyone's expecting basically the next couple of weeks to be choppy, depending on who wins, by how much they win, and whether it takes 1 week or 2 weeks or 3 weeks to have certainty of who the new U.S. President was. But it struck me that he was very upfront about it. He wanted to talk about it as a kind of question mark about what happens. And then the other one, Tom, you were mentioning, is this capital requirement by the Swiss regulation, which really shook the market when we found out. And it doesn't seem that it's moving at pace. So I tried to get from Sergio Ermotti about, first of all, the amount, but also the timeline. He says discussions with the governments are just at a technical level right now. We were meant to have a little bit more news by the end of the year, but it's basically now. And that could range between 10 billion or 20 billion. Those are the estimates in the markets, but nothing's been confirmed either on the government side or on the UBS side.
OK, fantastic work. Bloomberg's Francine Lacroix on the ground for us in Zurich after, of course, that interview with the CEO of UBS on the back of their earnings. Continuing the earnings story, but switching focus for a different sector, the auto sector, because VW shares are actually higher. That's despite the car maker posting its lowest profit margin since the pandemic. Losses possibly priced in from earlier this week. Let's bring in Bloomberg's Oliver Crook out of Berlin to make sense of all of this. Ollie, more bad news then for Germany's biggest car maker. But investors, as we said, maybe had priced in a lot of this bad news.
Yeah, Tom, it's hard for me to really tell what's priced into the auto market because sometimes you get news and then you see the shares go plunging like we saw with Stellantis and that sort of profit margin they had. And then now you have a day like today where you had, admittedly, Volkswagen put out a lot of bad news over the last couple of weeks. And today that the sort of investors are sort of taking what they got in the third quarter in stride. What they got in the third quarter were vehicle sales down 8%, an operating result down 42%. And really the key metric, Tom, that we're always paying attention to are the margins, the return on sales on individual cars. And that is where we saw the lowest return on sales since the pandemic, coming in at 3.6%. That is down from 6.2% last year. And when we dig into the individual brands, the VW brands, so this is the sort of cars with the VW printed on the front, this is where all of those very difficult factory closures, job cuts, and possible pay cuts are going to be coming from. That margin over the last 9 months was only at 2%.
Yes, and the weakness of the auto industry, Ollie, clearly playing into the wider German scene, the German economic landscape. French and Spanish growth data came in ahead of expectations this morning, but we'll wait to see what Germany manages to deliver. That's coming in half an hour or so.
Yeah, that's right, Anna. And if we can get a little bit of a boost to that number, then what you could get is potentially avoiding a technical recession in Germany. The expectation right now is for a second quarter of contraction of 0.1%, which would mean, again, a technical recession. But really the top line sort of argument here on the German economy is that regardless of really what happens quarter to quarter, this is going to be a second year of consecutive contraction. We've only had 2 consecutive years of German contraction once before since the Berlin Wall fell, to really sort of illustrate the scale of what's going on here. And we're really seeing where the sort of rubber hits the road on this in the real economy with these job cuts that we're talking about over at Volkswagen. We're going to also be getting, Anna, very closely watching the CPI data from all the regions in a couple of hours, and then the final print this afternoon. The issue you're getting here in Germany right now is you're having a situation where growth is slowing down, we're having contraction, and at the same time, inflation is coming back up. We're expecting it to print at 2.1% in October, up from 1.8 over in September.
Yeah. Is that stagflation, I wonder, as a prospect for Germany? Oliver Crook, thank you very much indeed on the German economy and, of course, breaking down the VW results for us. Talking of Volkswagen, they've invested heavily in Northvolt, which is one of the big bets in Europe around building out our own supply, Europe's own supply, at least, of electric vehicle batteries. And that company has faced numerous financial struggles. The latest lines crossing from Volvo Cars, another backer. So some key backers include VW, Volvo and Goldman Sachs. Volvo Cars coming out and saying that they have invoked the right to buy Northvolt Northvolt's shares in Novo Energy, which is a joint venture between Volvo Cars and Northvolt. Volvo Cars saying they've identified and notified their counterpart, and they've said that this action follows a breach of Northvolt's agreement where Northvolt has not fulfilled its financial obligations. Volvo Cars, by the way, saying that this will not impact the cash flow targets for the business. They're going to have full ownership now, it seems, of this company, Novo Energy. It's not going to impact their rollout of cars and vehicles as well.
And Volvo Cars saying that they intend to have a constructive dialogue with Northvolt on this matter, but this all sounds fairly drastic, doesn't it? So we'll continue to monitor that one and how Novo Energy performs if it is all going to end up in the hands of Volvo Cars. Coming up on this programme, we'll turn our attention back to the budget conversation here in the UK. We're going to be talking to the former Chancellor of the Exchequer, Phillip Hammond, ahead of the Labour government's first budget, this Labour government's first budget later today. So Phillip Hammond will be in Westminster speaking to our colleague Lizzie Burden. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into today's session. Checking in on the gilt markets. As you see, in fact, across UK sovereign debt, a bit of a move in, a bit of a relief across UK gilts. They are gaining in the session today. Yields are down at between 3 and 5 basis points. 3 at the front end, 5 on the 30-year. The context, of course, is you have seen a sell-off at the 2-year level. You've seen yields up about 20 basis points just since October the 18th on expectations that maybe you get a little bit more borrowing from this UK government. And of course, it is budget day today, so there could be volatility around these gilt markets. In the session today, we will be keeping an eagle eye on them. UK Chancellor Rachel Reeves, of course, expected to unveil a major package of both tax hikes and extra borrowing when she delivers her first budget today. Let's bring in Bloomberg's Lizzie Burden, who's standing by for us with a guest. Lizzie.
Well, Tom, this is a budget that's set to define British politics for the rest of the decade. Politically, it's an opportunity for Keir Starmer to reset the narrative. We've had this summer of economic doom and gloom. But also, as you say, it's consequential for the markets. Rachel Reeves has waited longer than any of her predecessors and at least half a century to deliver this first budget. A lot of pitch rolling. Will it be enough to temper that market reaction? I'm pleased to say that we're joined now by someone who's sat in her shoes, someone who has delivered a budget himself. It's former UK Chancellor Phillip Hammond. Lord Hammond, really good to have you with me. You've done this yourself. What would be your advice to Rachel Reeves today?
Well, the first piece of advice would be if you've got difficult stuff to do, today is the day to do it. First budget of a new government. I would expect her to set a clear course, which the government intends to stick to at least for one parliament, possibly for more if they're expecting to get re-elected. So there is the temptation to postpone difficult things until later is never good. Is never a good idea, because it always gets more difficult. Even
if, for example, we've got the US election coming, there could be a return of Donald Trump to the White House, there could be a more inflationary global landscape. She shouldn't be cautious about that.
Well, of course she should be cautious about all of those things, but the British economy needs attention. Keir Starmer and Rachel Reeves told the British people in the run-up to the general election that the Labour Party had changed, that it had understood at last that you cannot fix Britain's economic problems by ever more taxation and ever more borrowing that we can no longer afford, and that the only solution was growth. Now, that was a very reassuring message, and a lot of people will have voted Labour on the basis of the message that Labour was going to be adult about the way it managed the economy. And today, Rachel Reeves has got to show that they're going to deliver on that promise, that they are going to announce a budget for growth in the British economy, so that over the medium term we will all be better off, our public services will be able to be better funded, and all of this on a sustainable basis.
So if Labour can get this 2.5% growth, would you be crossing the aisle?
I don't know about crossing the aisle, but I will certainly give them credit for it if they can achieve 2.5% economic growth. But that is not going to be an easy thing to do at all, and you're not going to do it by moving the goalposts so that you can borrow more money. That will give you a short-term fix, a sugar rush, if you like, but that is not the same as fixing the supply side of the economy, making this an attractive place for investors, for entrepreneurs, for wealth creators to locate themselves. And I have to say, the run-up to the budget, the cacophony of leaks we've had over the last couple of weeks doesn't sound terribly promising. It sounds like I'm going to move the goalposts so that I can borrow more money. I'm going to load employers with more national insurance contribution. I'm going to change capital gains taxes to make this a less attractive place for entrepreneurs and wealth creators. None of that is going to deliver economic growth.
But in the post-Liz Truss era, isn't it the responsible thing, you could argue, to trail what you're going to do in order to curb the market reaction?
Well, if you've got a particular market issue to manage, that may be right. And I'm not criticising them for trailing some of what's in the budget today, and I don't suppose they've trailed it all. There's detail we don't know. We don't know what she's going to do to capital gains taxes. We don't know exactly what the scale of her hit on employers' national insurance contribution is going to be. We don't know if she's going to do anything on the taxation of pensions and pension contributions. So all of these things will hopefully be revealed later on today. What I would say is that although individuals will obviously be looking at the budget in terms of specific taxes and how they affect them, the right way to judge this budget will be as a package. Overall, is this a budget for sustainable long-term economic growth in Britain? And that's certainly what Labour promised the British people. If they don't deliver a budget for long-term growth today, then they will have abandoned the central plank of their economic policy, which is that you have to do it through growth rather than through borrowing or taxation, and they will have betrayed, frankly, millions of people who voted for them.
But I mean, you started by saying your advice to Rachel Reeves is she needs to get the difficult decisions out of the way up front. Given the fiscal picture, even as a Conservative, wouldn't you agree that some tax rises are necessary?
She may need to do some tax adjustments, I agree with that, but she also needs to be robust on public spending. And the omens are not good. The very first thing this government did when it came into office was concede an unaffordable pay package to public sector workers who happened to belong to a union that had been financing the Labour Party in the general election campaign. That is actually not a reassuring message for those unpolitically committed members of the electorate who voted for them because they thought that Labour had got the message at last.
And then on the spending front, I mean, Rachel Reeves has promised no return to austerity, which of course was a Conservative policy that you sought to end. In your view, what would count as a return to austerity?
Well, I'm not sure what Rachel Reeves means when she says no return to austerity. I mean, throughout the period of Conservative government, spending on public services increased. But we were not able to increase it as fast as perhaps we would have liked to have done if the economy had been growing more strongly because of the effects of the global financial crisis. Now, every Chancellor must cut their coat to fit the cloth. We've got a rapidly ageing population, which means more and more demand for public services, and we will have a shrinking working age population over the coming decades. And it's no good just pretending that doesn't exist. Somehow we can keep on taxing a smaller number of people more and more to pay for public services for an ever larger group. We have to have an honest debate across the political parties with the public about how we're going to evolve our welfare state for an era when we no longer have 2 or 3 working age people for every person who's being supported by the state in old age. It's a different world.
Just before we let you go, Lord Hammond, I have to ask you about your own party. The race to be the next leader is on. Would either Kemi Badenoch or Robert Jenrick make a decent Prime Minister?
Well, I'm not going to speculate on what emerges from the Tory party leadership competition. What I would say to both candidates is the way to win power back is to move to capture the centre ground. Keir Starmer spotted it by getting elected as virtually a Corbynista and then moving steadily to the centre of the party. He showed that he understood what the British public wants is centre ground politicians that can do a competent job of managing the economy and the public services. The test for Keir Starmer today is whether he can follow through on what was a very effective line of rhetoric during the election.
So
whoever wins the Tory party leadership needs to move for that centre ground. The battle will be on the centre ground. Chasing votes on the right wing of the Tory party and beyond is not the way to win a general election.
So for now, he's more sensible than both of them?
Well, let's wait and see what happens in the Tory party leadership contest.
I'll read between the lines there. Phillip Hammond, Lord Hammond, former UK Chancellor of the Exchequer. Lovely to have you with me. Ahead of this UK budget, the first from our new Chancellor, Rachel Reeves. Tom, Anna.
Lizzie, thank you very much. Bloomberg's Lizzie Burden there with the former Chancellor of the Exchequer, of course, Phillip Hammond, Lord Hammond there, talking to Lizzie about a host of matters. Actually giving some credit, I think it seems, in some areas around the way that the Labour Party has managed, has promised at least to manage the economy, and we'll see what they deliver. We'll have special coverage of the UK budget. That's coming up at 12:30 p.m. UK time. And so I'll be here in this seat to do just that. So interesting, he was giving some credit there, but he was also pointing, of course, to the areas that he didn't like. And one of the areas that he was not keen on was, if you want to attract wealth, and if you want to build growth, if you want invest as the trail this morning suggests, then you're going to need to encourage entrepreneurs and the like, and maybe putting up employee national insurance and hiking CGT. Maybe that's not the way to do it, in his view.
That is the central tension, isn't it, for this Labour government, is how to get that growth, how to get that investment, whilst also raising the capital and the tax raise that they feel they need to fill that fiscal hole. And the details, of course, we know they're going to raise capital gains, but by how much? We know they're going to put up national insurance contributions for employers, not employees, but by how much? So the details, of course, the granularity on that front. Will they keep any carve-outs for investors, for example? And I've been speaking to investors in the tech space. They're generally very concerned about this, and they generally are rethinking to what extent and how much risk they want to be taking in terms of backing some of these innovative companies in the UK that are going to drive that future growth.
And we'll certainly keep an eye on how gilt markets respond here. I thought it was really interesting, our guest in the first hour of the programme, talking about how this might be a budget where, yes, we see higher taxes, but also we see higher fiscal headroom provided by new debt rules, but not necessarily entirely used up this time around, giving them somewhere to go at later budget events. So we'll see if that's something that the Treasury is listening to. So lots to talk about when it comes to the UK, and we'll have further on the budget later on today, of course. Coming up, we are getting closer to the US election. European officials are increasingly concerned about the potential return to trade barriers. We are going to be speaking to the CEO of one of the largest shipbuilders in Europe. Fincantiori, the CEO of that business, joins us next. This is Bloomberg.
Trump's talking about expanding his tariffs, and Biden's Inflation Reduction Act, kind of misnamed, is very protectionist. I mean, the Europeans are livid about it. He does things that where you have to buy American in many ways. So they're certainly the two most protectionist presidents in a long time.
It is not in the interest of the U.S. to follow protectionism.
The European Union is the most open place of the world. But you cannot survive if at the same time you have subsidies and overcapacities in China and protection in some part of the market, and Inflation Reduction Act and Buy American Act in the US. It doesn't fly 1 second.
Leaders weighing in on the changes to the relationship between the US and Europe, talking about the Inflation Reduction Act and other measures. We want to zero in on the topic of industrial policy as part of our daily series focusing on the issues facing Europe in the battle between Kamala Harris and Donald Trump. Our next guest is perfectly placed to give us a view about the health of Europe's manufacturing sector. I'm very pleased to welcome to the programme Pierroberto Folgiero, the CEO of Fincantieri, one of the largest shipbuilders in Europe. Pierroberto, very nice to speak to you. And your company makes merchant vessels, naval vessels, everything from cruisers and ferries to supplying the Navy. So it's a wide range of business. Which parts of the business are performing best for you right now?
This is the era of defense. We strongly believe that there is an investment cycle in front of us in the increase of the naval capacity all over the world. So we get along very well with our historical clients, and we are at the same time getting along with new navies that are investing more and more in the naval space.
We've seen that defence businesses have, of course, benefited to a large degree, or been there to supply the wars that are taking place at this point. And, of course, I'm thinking of Russia's invasion of Ukraine in that regard. How are you thinking about the potential for a change of leadership in the United States and whether that changes the demands on the defence sector or not?
I think it's whatever is the result. Again, we are in front of a geopolitical cycle that is calling for security. It is becoming, to me, a kind of second S of ESG. People is asking for security more and more. And then I would add that the naval defense is a little bit different from the others, because Navy is about deterrence, is about protection of commerce, is about protection of seabeds. So on top of the sense of urgency of today, as a kind of benefits that goes beyond even this emotional period we are living and we are expected to live.
Of course, we'll let the Americans make their own decision about who is going to be in the White House. But if we saw another Trump presidency, would you see that as leading to more defence spending or less defence spending? We know very well that he doesn't want to intervene in Ukraine, for example, to the same degree that the current leadership does.
I believe that, again, Ukraine is a kind of contingent situation. I believe that this long-term insecurity will go beyond it. The world will get out of this crisis divided into blocks. And every bloc will have to take care a little bit more about its security, so will therefore increase the defense capacity, and at the same time the industrial capacity you need for defense capacity. So I think the regionalization of certain activities will take place, whatever is the scenario, and I strongly believe that defense is one of the key building blocks of regionalization.
Is consolidation in defence in Europe, is it happening quickly enough?
I believe that the first thing that should happen in Europe is defragmentation. So we have a defense budget that is a fraction of the defense budget of US, but we have a number of platforms being a multiple of the number of platforms of US. So I believe that defragmentation in Europe will be the way according to which we will spend better before spending more. You know what I mean?
And what role will you play in that defragmentation? To what extent are you going to be looking at acquisitions? You've been raising capital, you've got a pretty strong balance sheet. Are you prioritising paying down debt or making acquisitions?
But I think the first way for us to be useful is to be in the middle, in between Italy and France, with a joint venture on the naval business, and being in commercial collaboration with Germany for the underwater domain. And being at the same time in the transatlantic collaboration, because we build frigates for US Navy. So our frigate, for example, can be a way to help the defragmentation in Europe and even help the NATO standardization. You know, the NATO doctrine is about interoperability and interchangeability, and in order to achieve it, it's very good to share platforms, at least passive platforms.
And NATO withstands a Trump 2.0, you think, if that's what comes to pass?
Yes, yes, I think it's, again, I believe it's written in the stone. We have to go in that direction. And we have to explain to taxpayers that security is a social need. So even the increase in expenditure has to be understood as a prerequisite for the rest of the freedoms to be there.
Can you talk to us about some of the deals that you've been associated with, some reporting around interest maybe in, for example, ThyssenKrupp Marine Systems unit? Are you still interested in that unit when you talk about defragmentation? If you can answer that one. And also, as well, in terms of Leonardo, the WASS deal, is that still on track for early 2025?
Absolutely, yes. So the deal with Leonardo is on track. Is our contribution to the creation of a very strong underwater company. We believe underwater will be another macro trend of the future we have in front. There are a lot of technologies to be validated in that domain with the navies. So again, it's another example of how defense expenditure can validate new technologies that then can be expanded in adjacent markets, such as energy at sea, such as seabed mining. So underwater with the transaction of Leonardo will be the creation of our division.
Still interested in ThyssenKrupp's Marine Services unit?
We've been collaborating with ThyssenKrupp Marine Systems since 25 years, so we know each other very well. We put on the market a very strong product, which is a submarine that is non-nuclear, and so having also a lot of interest in the exports in countries on our geopolitical platforms. Now it's time for the German institutions to understand what's the best strategy to valorize and to strengthen the very good company they have, which is ThyssenKrupp Marine Systems. We are at their disposal on any possible forms, starting from enhancing commercial collaboration up to other forms of collaboration in order to be instrumental to their national strategies.
Pierroberto, thank you very much for joining us. Pierroberto Folgiero, the CEO of Fincantiori. We thank him very much for joining us today. Now, thinking about the US election and questions that people might have, Bloomberg News strategists and reporters will be participating in a live blog Q&A and answering questions from Bloomberg subscribers on what the US election means for their money, for the economy and for businesses. And you can email your questions for that Q&A to bloombergqa@bloomberg.net. You can watch the Q&A at it's a T-Live blog, so TLIV Go, on the Bloomberg terminal and on the Bloomberg.com website.
OK, let's get more on tech earnings and the AI divergence story as well that we are starting to see. Alphabet shares higher, while AMD, of course, the maker of those accelerators, AI accelerators, slumping. Around 8.7% right now, pre-market trading. Let's dive deeper into the tech story, bringing Bloomberg's Newly Purnell, who's been covering all of this for us and has a finger firmly on the pulse. Newly, how much progress is Alphabet making in addressing those investor concerns about whether that massive spend on AI investments is actually paying off for the business?
Right, that's exactly what investors want to know. You know, Google has been pouring billions of dollars into various AI efforts. They're competing against some big names out there, Microsoft, OpenAI, Meta. Investors want to see when is it going to pay off. And a number that really jumped out from the earnings, 35%, that's the growth in cloud sales that they saw in the quarter compared to a year earlier, and they cited AI services as part of those that cloud offering. So that's a number that jumps out that investors will say, okay, here the company seems to be recouping some of its outlays.
OK, so that's the news around Alphabet. We got that last night, Newly. We also got those AMD numbers. But let's throw things forward here and think about the earnings stories still to come on the tech space. We're going to get Microsoft and Meta reporting later today. At least part of that keeps us focused on the cloud. What else are you expecting?
That's right. Well, continuing the theme of AI, Microsoft revenue, people will be watching what's going on with Azure Cloud for them. They saw their sales growth slow a bit in the previous quarter, so investors will want to know as they roll out their generative AI offerings across a variety of products, what's going on with their cloud unit. And then, again, Meta. Mark Zuckerberg has a balancing act on his hands. He wants to invest billions in what he says is the wave of the future, metaverse and AI. And investors will want to know, are they making back the sales from that? And one particular aspect that they've been honing in on is AI-related tools to let advertisers look more specifically to users they want to advertise to, which is, of course, the core of Meta's business. So that's something that we'll be watching.
Newly, thank you. Thanks for the update. Bloomberg's Newly Purnell with the latest on what we've seen and what we're yet to see from the tech sector. Let me just update you on some of the data that's coming this morning. We've talked about the French GDP. We're waiting to get German GDP coming through. We'll get the euro area wide number as well. We have the UK budget coming. That's at 12:30 UK time. Of course, we get German CPI. The ECB's Schnabel, Villeroy and Nagel will all be speaking today. And we will have those US tech earnings, Meta, Microsoft, as we were just hearing from our colleague in Hong Kong a moment ago. So this GDP story, we're expecting the data then out. We'll see whether we get that weakness in the German number. So far, the French and the Spanish numbers have managed to come in a little ahead of expectations. Yeah,
maybe some green shoots for this European economy, but you have to carve out Germany out of the picture, don't you? Because the expectation is that you're going to see a recession confirmed, a technical recession in Germany. But we'll see if the data confirms that. The euro getting a little bit of a lift in the session, currently, Anna, at 108, just up 0.2%. Yes, and the broader picture for European stocks is a negative one, isn't it? We're down by 0.7%.
1%. The CAC 40 in particular down by 1%. Some of the heavyweight luxury names being weighed down perhaps by some of the earnings coming through from the likes of Campari, which is a pretty heavy faller in Milan, and that taking the edge off some of the luxury names this morning. 8:56 here in London. Time to tell you what is coming up in tomorrow's programme. Don't miss our exclusive conversations with the CFO of BBVA and the CEO of Sabadell. We'll be talking banking consolidation in Spain. This as the potential tie-up between these two Spanish lenders comes under wider scrutiny. That'll be part of the conversation tomorrow. We'll have plenty of budget coverage here in the UK still to come today. That is it for the opening trade. This is Bloomberg.